continue to have constructive view on Indian equities over the next few years. This is primarily because we expect economic activity in India to continue to accelerate, which will translate into corporate earnings growth over the next few years to be at a higher trajectory than what we have witnessed over the last several years. However, investors should be mentally prepared for a higher degree of volatility and corrections from time to time. In terms of human cost, second COVID wave proved to be much more costly compared to the first one. However, when it came to economic cost and market impact, second wave was less severe compared to the first one. Primarily because governments chose short-term local lockdowns to control the virus as compared to the long national lockdown that was implemented last time, which actually completely stopped the economic flywheel. In the year gone by, Nifty companies posted earnings growth in mid-teens. This was significantly better than 2% earnings growth that Nifty companies reported for 7 years ending FY20. Over the next few years, we expect earnings growth to remain buoyant, primarily led by economically leveraged sectors such as industrials and financials. Based on broad-based economic recovery, weak base of 2018 and 2019, and historical pattern, we do expect small caps and mid caps to outperform large caps over the medium to long term. However, we should acknowledge that we have already traveled some distance on that path over the last 15 odd months. Also, do not forget that generally small caps and mid caps will have higher degree of volatility compared to large caps. Our view that Indian economic activity is likely to accelerate is reflected in our portfolios. If you look at our portfolios, you will find that we are overweight on economically leveraged sectors such as cement, industrials, real estate. In the mandates where it is allowed, you will find that we own higher proportion of mid caps and small caps compared to a year ago. Our medium to long-term view on Indian equities continues to remain constructive. However, investors should mentally be prepared for corrections in the market from time to time and higher degree of volatility. But we should always remember that for long-term patient investor, volatility is a friend, not an enemy.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.